Okay, you are joining us for another deep dive. And after our last expedition, remember the Theranos roller coaster? Well, buckle up, because you've pointed us towards a story that's every bit as captivating and maybe even more, mind-bending.
Yeah,
We're plunging into the strange and ultimately tragic saga of Sam Bankman-Fried.
absolutely. This isn't just a tale of money lost and found, or rather, mostly lost. It's a human story that zigs and zags from, the high-stakes worlds of MIT and Wall Street
Right.
to the hyperdrive of crypto, landing us squarely in the middle of questions about ambition, belief, and what happens when the lines between right and wrong get, well, let's just say, blurry.
Definitely blurry.
We're looking at the rise and very public implosion of FTX, the brainchild of a guy who, for a while there, seemed like the golden boy of crypto.
A quirky math wizard, as one source delightfully put it, who conjured up this crypto castle in the clouds.
Yeah.
And the truly fascinating part is how he managed to convince so many incredibly sharp people, investors, regulators, even celebrities, that he was some kind of financial visionary, maybe even the industry's savior.
It's incredible when you think about it.
It's a narrative packed with these dizzying contradictions. A philosophy supposedly rooted in altruism, somehow leading to alleged fraud on a massive scale. The image of this kind of disheveled boy genius, perhaps masking something much more calculated. And the company culture, oh boy, that's a story in itself.
Right. And as we wade through the stack of information you've shared with us, articles, analyses, the whole 9 yards, our mission isn't just to rehash the timeline. We want to dig deeper.
Exactly.
What were the initial sparks that ignited Sam Bankman-Fried's trajectory? How did this earning to give idea take root and, evolve?
And ultimately, what can this whole FTX debacle tell us about how we as humans sometimes operate the psychology that allows for this kind of alleged deception, the sociological aspects of these companies that almost develop their own belief systems?
Like a cult, almost.
Sort of. And that age-old ethical tightrope walk of whether good intentions can ever pave the way for questionable action.
Exactly. You've challenged us to sift through the noise and bring you the signal, the key takeaways, those head-scratching facts, the moments where the penny just drops and you think, ah.
Right, without getting totally lost in every single transaction and tweet. We're here to be your guides through this intricate and frankly pretty wild landscape. So ready to jump in and see what makes this whole thing tick.
Absolutely. Let's rewind a bit and look at the very beginning, those early influences that seem to have really set the stage for the Sam Bankman-Fried story.
Okay.
A key moment that keeps popping up in the sources is his introduction to effective altruism during his college years.
Yes, it sounds like this philosophy, this core concept of earning to give, really resonated with him on a fundamental level.
Apparently so.
Apparently, he heard William MacAskill speak at MIT, and the question MacAskill posed was so compelling. What if the most ethical path wasn't necessarily working directly for a charity, but instead pursuing a high-earning career with the express purpose of donating a significant chunk of that wealth to maximize good in the world?
It's a fascinating twist on traditional philanthropy, isn't it?
It really is.
What's fascinating is how this idea really took hold. Sam immersed himself in the work of utilitarian thinkers like Peter Singer, philosophers who advocate for maximizing overall well-being through rational action.
Okay.
He became deeply involved in the effective altruism community, and this notion of amassing billions not for personal gain, but as a moral imperative, to then deploy that capital to save lives and improve global welfare, became a central driving force, at least in theory.
So when you first heard about this earning to give philosophy, what stood out to you? Did it immediately make sense as a motivator?
On the surface, it's incredibly appealing. It's like a superpower for doing good.
Right.
But I think what's so crucial to remember here is that this wasn't just a personal conviction. The sources really emphasize how this became a cornerstone of his public image.
Okay, the narrative.
Exactly. This narrative of the benevolent future billionaire was carefully cultivated. It almost became the foundational myth upon which his later actions, both the lauded and the allegedly fraudulent, were built.
Right. And after graduating from MIT, armed with this philosophical framework, Sam sought out a path that would not only hone his financial acumen, but also allow him to start accumulating the wealth he intended to give away.
Which led him to Jane Street Capital.
Jane Street, it keeps coming up as this hyper-selective quantitative trading firm. It's described as incredibly intense, very data-driven. What was it about this environment that seemed to suit him so well?
Well, by all accounts, he thrived. The information suggests he quickly demonstrated exceptional aptitude. Within a relatively short time after joining in 2014, his superiors apparently saw a trajectory where he could potentially be earning upwards of $75 million annually within a decade if he remained with the firm.
Wow, $75 million?
Yeah. His forte was arbitrage trading. That's where you exploit tiny price discrepancies in different markets.
Yeah.
And he became highly skilled in trading complex financial instruments, like exchange-traded funds or ETFs.
Right, ETFs. Baskets of assets trading like stocks.
Precisely. So it was a perfect storm for his quantitative mind. The sources mentioned that Jane Street's culture, with its focus on data and logic, felt like a natural fit. He was surrounded by other individuals wired in a similar way.
Makes sense.
And importantly, this high-paying environment allowed him to start putting his earning-to-give philosophy into action. He began donating a significant portion of his already substantial salary.
So he was actually doing it, walking the walk.
He was walking the walk, so to speak. However, by 2017, it seems his ambitions began to stretch beyond the more conventional boundaries of Wall Street. The sources point to a growing desire for a more profound impact, to build something with a wider reach than just a successful trading career. The scale of his philanthropic goals demanded a bigger engine.
Which is when he took the plunge into the then uncharted waters of cryptocurrency. Late 2017, a period often described as the Wild West of crypto.
Total Wild West. Markets were fragmented, regulations were still in their infancy, and the big institutional players hadn't yet fully arrived.
And this nascent and somewhat chaotic environment presented a unique opportunity for someone with Sam's arbitrage expertise.
Definitely. While he did spend a brief period at the Center for Effective Altruism, his attention soon gravitated towards a much larger arbitrage opportunity he'd identified specifically within the crypto markets.
And that was the price discrepancy of Bitcoin across different geographical locations, wasn't it? Specifically, the notably higher price of Bitcoin in Japan compared to the United States.
Exactly. Classic arbitrage, but crypto style.
It's almost like a classic arbitrage play, but on a global, decentralized asset.
Precisely. The sources indicate that Bitcoin was sometimes trading for as much as 10% more in Japan than in the US.
10%?
Yeah. For someone with the capability to buy low in one market and sell high in another, this price differential represented a substantial, virtually risk-free profit margin. It was, in essence, free money for those who could navigate the logistical complexities.
Which, naturally, leads to the founding of Alameda Research in October 2017. It was established with the explicit purpose of capitalizing on this crypto arbitrage opportunity. I found it interesting that they consciously chose a name that sounded more like a research institution than a high-stakes trading firm.
Yeah, like a think tank.
Right, perhaps to project an image of stability and thoughtfulness.
That's a keen observation.
Yeah.
And while the basic idea of buying Bitcoin in the US and selling it in Japan sounds relatively simple, the execution at scale was incredibly intricate.
I bet.
We're talking about moving vast sums of money. The sources mention figures as high as $25 million in Bitcoin and yen daily.
$25 million a day.
A day. Which adds up to around $1 billion every 40 days across borders. The logistical hurdles navigating different regulations, currency exchanges, and the sheer volume of transactions must have been immense.
Unbelievable. But the profits, by all accounts, were equally immense. This early success really cemented Sam's reputation as a crypto prodigy, someone who could seemingly conjure wealth from thin air.
Must have been incredibly validating for a 25-year-old.
Totally. To be orchestrating trades of that magnitude?
Without a doubt. This period also provided a critical education in the friction that existed between the rapidly evolving crypto space and the established traditional financial system.
Right, the banks and regulations.
Dealing with banks, regulatory frameworks, and the practicalities of moving such substantial capital daily gave Sam firsthand insight into the inefficiencies of the existing infrastructure.
Okay.
This experience, this frustration with relying on external platforms, directly fueled his vision for his next, much grander adventure.
Yeah.
The creation of a better cryptocurrency exchange.
So that's where the FTX idea started simmering.
Seems like it. And by 2018, Alameda Research was, as the sources put it, flush with the proceeds from these arbitrage victories.
Right.
They became a significant force in the crypto world, capable of influencing market movements and providing liquidity. It wasn't entirely smooth sailing, though. They did experience some losses due to the inherent volatility of the crypto markets.
That's an important point to remember. Crypto's always been wild.
Always. Alameda was certainly not immune. However, overall, Sam's aggressive and opportunistic strategies proved highly profitable, leading to a rapid accumulation of personal wealth.
Already a multimillionaire, just a year out of college.
Pretty much. This early financial triumph seems to have further solidified his move fast, seize opportunities, figure out the details later approach.
Yeah, you can see how that could work.
Or backfire.
Exactly. It's a mindset that can be incredibly effective in certain situations, but also carries inherent risks. It paints a picture of a very high-pressure, always-on environment. The sources describe Alameda's initial setup in a crowded apartment in Berkeley where everyone lived and breathed crypto 24/7.
Like a crypto frat house, almost.
Sounds like it. A hyper-intense college dorm for traders. What do you think that kind of environment does to people, that constant immersion in such a high-stakes world?
Well, it can certainly breed a strong sense of camaraderie and shared purpose, especially when coupled with a mission like earning to give.
Sure, the us against the world vibe.
But it can also blur the lines between personal and professional life to a potentially unhealthy degree. And when you add in the kind of rapid success they were experiencing, it can create a sense of invincibility, maybe even a feeling that the usual rules don't apply.
Exactly. And while these scrappy beginnings might have seemed exciting and dynamic at the time, that lack of formal structure, that youthful exuberance you mentioned, in hindsight, really seems to foreshadow some of the much larger organizational and control issues that would plague his later endeavors.
Definitely seeing the seeds planted there.
As Alameda expanded, Sam began to assemble a core team of individuals he trusted implicitly. The sources highlight several key early recruits.
Right, the inner circle. Caroline Ellison, who also had a background at Jane Street and would eventually become co-CEO of Alameda.
Okay.
Gary Wang, his friend from MIT, and a brilliant coder who became the CTO and co-founder of FTX.
MIT connection, right.
And Nishad Singh, a friend of Sam's brother who is a talented software engineer from Facebook, focusing on building their software infrastructure.
What strikes me about this initial team is how interconnected they were, mostly in their mid-20s, bound by these shared experiences and, it seems, a deep belief in Sam's vision.
Yeah, very tight-knit. This inner circle would become absolutely pivotal in the creation and ultimately the downfall of FTX.
And by early 2019, Sam's frustrations with the existing cryptocurrency exchanges, the slow speeds, the frequent outages, the lack of sophisticated features for professional traders really began to escalate.
He wasn't happy with the tools available.
Seems not. This dissatisfaction became the catalyst for his decision to create his own exchange, which he named FTX, short for Futures Exchange. It launched in the spring of 2019.
A hugely ambitious undertaking, aiming for this vertical integration within the crypto ecosystem.
And Sam himself, according to the sources, gave it only about a 20% chance of actually succeeding.
Wow, 80% chance of failure in his own mind.
Building a major exchange from the ground up is a monumental task, especially in such a rapidly evolving and competitive market. What do you think gave him the confidence to even try?
Well, I think a couple of things were at play. First, his early successes with Alameda had likely given him a significant boost in self-belief.
Sure, he'd already won big once.
Right. He'd already proven he could navigate the complexities of the crypto market and generate substantial profits. Second, his frustration with the existing infrastructure was genuine. He saw a problem and believed he had the skills and vision to create a better solution.
And maybe that effective altruism angle, too.
And perhaps underlying it all was that driving force of effective altruism. A belief that by creating a more efficient and robust crypto platform, he could ultimately facilitate even greater wealth generation for philanthropic purposes.
Okay. FTX's initial launch was relatively quiet, based in Hong Kong. In those early days, it sounds like Sam was really hustling to attract users.
Totally grinding, leveraging his network from Alameda and actively engaging with the online crypto community, emphasizing FTX's lower fees and more user-friendly design.
Growth was gradual at first, but then they seemed to hit on something with innovative offerings like leveraged tokens, which apparently resonated with more sophisticated traders.
Yes, those novel financial products seemed to be a key differentiator in a crowded marketplace. By late 2019, the trading volume on FTX was beginning to gain traction.
And Sam's consistent self-promotion, his active presence on Twitter, where he blended a kind of nerdy humor with discussions about effective altruism, really helped him connect with the crypto community in a unique way.
Yeah, he wasn't your typical anonymous finance guy. He had a personality, a brand.
Exactly. The sources highlight how this unusual combination of talking about donating to charity one minute and high-frequency trading the next was intriguing to potential customers and helped FTX stand out from the crowd.
Definitely memorable.
Still, it's crucial to remember that at this stage, FTX was still a relatively small player compared to established giants like Binance and Coinbase.
Right, it's still the underdog.
It was the massive crypto boom of 2020 that truly fueled their rapid ascent.
The year 2020 was a watershed moment for the entire cryptocurrency market. As Bitcoin and other digital currencies experienced a historic and dramatic surge in value, trading activity exploded.
Everything went parabolic.
Right. And FTX was perfectly positioned to capitalize on this wave of enthusiasm. Their trading volume and user base grew exponentially as more and more individuals and institutions flocked to any platform that offered access to this booming market, often with the allure of high leverage.
And Sam was quick to seize this opportunity, rapidly rolling out a continuous stream of new products and features, crypto futures, options trading, more complex leverage tokens, all available on the FTX platform.
He was moving fast. But a really pivotal element in their explosive growth seems to have been the introduction and the role of the FTT token.
FTT, the exchange token.
It wasn't just a way for users to get discounts on trading fees. It was strategically designed as a loyalty program, almost like an internal currency within the FTX ecosystem.
Okay, but how did that fuel growth exactly?
What's particularly interesting here is the intricate web of interconnectedness that Sam created. Alameda Research, which he still effectively controlled, became the primary market maker for the FTT token.
So Alameda was propping up the price.
Playing a crucial role in maintaining its price and ensuring its liquidity, This directly tied the success of the FTX exchange to the perceived value of its own native token, creating a powerful, albeit potentially precarious, feedback loop.
I see. FTX does well, FT2 goes up, which makes FTX look stronger.
Exactly. As more people gain confidence in FTX and its future prospects, the demand for and the value of FTT increased, which in turn bolstered FTX's apparent capital reserves and perceived stability.
It's a clever, most symbiotic relationship, but also one that inherently introduces a significant point of systemic risk.
Huge risk. By the end of 2020, FTX had broken into the top tier of global cryptocurrency exchanges, and Sam, at just 28 years old, had become a billionaire on paper.
Billionaire at 28. Wow.
He started to receive more attention from mainstream media outlets, although nothing compared to the media frenzy that would later erupt.
As his wealth and influence expanded, Sam began to carefully cultivate a very specific public persona, the image of the everyman billionaire.
Yeah, the shorts and t-shirt look.
The sources repeatedly highlight his intentionally casual and often unkempt appearance, the trademark shorts and t-shirts, the way he downplayed his immense wealth and status. It was almost a deliberate rejection of the traditional image of a powerful financial titan.
Right. He almost seemed to be going out of his way to appear relatable, like this brilliant but slightly disheveled genius who was simply too preoccupied with changing the world to be bothered with conventional appearances.
And some of his colleagues later observed that this might have been a consciously crafted image, a strategic way to appear less threatening or intimidating to investors and regulators alike. What do you make of that? Genuine or calculated?
It's hard to say definitively, right? There might have been elements of both. Perhaps his focus was so intensely on his work that personal grooming genuinely took a back seat.
Plausible.
But the consistency of the image, especially as his influence grew, does suggest a degree of intentionality. By presenting himself as this unassuming boy wonder, he might have lowered people's guard, making them less likely to question his actions or the rapid growth of his empire.
Makes sense strategically.
He would often dismiss any suggestion of calculation, attributing his appearance to simply being too busy or even too lazy to worry about it.
But by 2021, this image had really taken hold in the public consciousness. He became something of a folk hero within the crypto community, the effective altruist, in shorts, who was on the cusp of becoming one of the wealthiest individuals on the planet.
And pledging to give it all away.
Right. All while publicly pledging to donate the vast majority of it for the greater good. It was a remarkably compelling narrative that seemed to resonate with a lot of people.
With that compelling narrative and the continued spectacular success of FTX came serious attention and substantial investment from the world of venture capital.
The big money arrives.
In mid-2021, FTX secured massive funding rounds from prominent firms like Sequoia Capital and SoftBank, leading to truly astonishing valuations. First $18 billion, then $25 billion, and eventually reaching a staggering $32 billion in early 2022.
$32 billion. Just incredible numbers.
These are numbers that put you in a different stratosphere of business. Suddenly, Sam was no longer just a crypto founder, he was being mentioned in the same breath as the titans of traditional finance in Silicon Valley.
He's on magazine covers now, right? Forbes, Fortune.
Exactly. Being hailed as a potential successor to figures like Buffett or Zuckerberg in the digital asset space.
Wow.
And in a significant move in July 2021, Binance's CEO, CZ, who had been an early investor in FTX, sold his remaining stake back to Sam for a cool $2 billion worth of FTT and BUSD tokens.
That seems like a pivotal moment in their relationship, getting CZ out.
It was a significant transaction. It gave Sam complete control over FTX by removing a potentially influential and perhaps eventually rival shareholder.
But maybe it created some bad blood.
But as the sources point out, this move also inadvertently sowed the seeds for a future, much more dramatic conflict between the two.